Hi, I'm Jimmy. In this video, we're looking at the Ford Motor Company, ticker symbol F. This company was a recommendation from one of our community members, and then what we do is we do a poll, the community votes, and Ford got the most votes, so that's the next company that we analyze. Okay, now, full disclosure, I actually own one share of Ford. Now, I didn't buy this share, I actually received it from Robinhood when a friend signed up for Robinhood using the affiliate link that I have. So if you're looking for an online broker, I'll leave a link to Robinhood below. And if you use it, then I get a share of some stock and you get a share of some stock, although we don't know which one. Okay, so first we're going to look at the basics of Ford's business, and then we're going to try to value Ford stock using a discounted free cash flow valuation method. Okay, so this is Ford's revenue going back to 2011. And as we could see, they break their revenue into two main categories. First is Ford Credit. Ford Credit does some financing for financing and leasing, mostly to help finance their automobiles, although they do have some financing activities for their automotive dealers. And then the other segment, their largest segment, is their automotive business, which clearly dominates their overall revenue. This segment includes the sale of Ford and Lincoln vehicles, plus any service parts. The segment also includes anything tied to their electric vehicles program. Okay, now if we dive in and look a bit closer at their automotive segment in 2019, well, we can see how they break that down. It looks like they made about 68% of their revenue in North America, then Europe accounted for another 20% or so, and then from there, each region got gradually smaller. Now, when we switch back to Ford's annual revenue, well, growth for Ford's revenue was about $136 billion back in 2011, and about $156 billion in 2019. And here's one of my issues with Ford in general. Over the past 8 years, that was growth of about 14%. Not 14% a year, 14% total. And clearly, that's a small amount of growth. We can't forget that this 14% growth occurred in the middle of one of the best economic bull runs in history, and it doesn't include anything tied to the coronavirus. Now, when we switch over to their net income, well, here we can see that profits have been all over the place since 2011. And I'm sure we can all see that Ford's profit margins have been quite small. They put up about $4.5 billion in profits during 2019, and that's on about $156 billion in revenue. So their profit margins are about 3%, which is quite small, although it's not too far away from some competitors in the industry. Fiat Chrysler and General Motors both have margins in the 4% range. So Ford is on the low end, but it's not like they're way lower than everybody else. Now this brings us to 2020 and the coronavirus. So clearly, the coronavirus has crushed auto sales in general. And here, when we look at US auto sales, well, we can see that auto sales have dropped off a cliff once the coronavirus hit the world. Now, as we could imagine, this pullback in auto sales is going to crush 2020 revenue, not just for Ford, but for all car manufacturers. And we know that back in May of 2020, Ford halted production in 2 of the US plants as a few of their workers tested positive for COVID. And then in recent weeks, Ford started turning out vehicles once again, which is in line with the fact that at least some parts of the United States are opening up again, and I'm sure we'll see at least some upticks in the number of cars being sold. Okay, now this brings us to the fair value of Ford stock. So right now, Ford has a price to earnings ratio of about 11x based on their past 12 months of earnings per share. And at first glance, this might sound like a pretty good deal, given that the average for the S&P 500 is currently 21x. But I think we should be very careful about using price to earnings right now, not just for Ford or automobile stocks, but really for any company, since the coronavirus has affected so many companies in so many different industries. Almost any company's earnings per share numbers are going to be on the low end, and that will likely make many companies look overvalued because their recent earnings have pulled back. So I'm not a big fan of price to earnings ratio during this time period. I much prefer discounted free cash flow, especially for a mature company like Ford. So one of the reasons I prefer to use discounted free cash flow is that near-term estimates are far less sensitive compared to the longer-term estimates. Let me illustrate what I mean. But before I do, if you're curious how to do this calculation, I did a video on a discounted free cash flow guide. I created an Excel template. If you're curious, if you want to see how to do this, there's a link in the description below. And by the way, I got these free cash flow estimates from analyst estimates that I was able to find. Okay, taking just 2021 as an example. Right now, we see about a negative $1 billion estimate. And discounting that back to today, we see that will give us a negative $909 million impact. But just to illustrate, what if we were to shift that negative $1 billion estimate to a positive $1 billion estimate, which would be a $2 billion swing in our estimates? Well, obviously, our $909 million becomes a positive number, and we can see that the fair value per share has stayed about the same. And that's because at the end of the day, most of the value from a discounted cash flow calculation is going to come from the terminal value, which in our case is tied to our 2023 estimates. So we discount those back by our required rate of return. We use 7.5% for that. And then our growth rate, our perpetual growth rate of 2.5%, we discount that back to today. That gives us our total company value. Those are the most important numbers in this whole calculation. So our question is, with these estimates at our 2023 numbers, we got about $6 billion estimate. Are they reasonable estimates? Well, if we were to switch over to a chart of free cash flow going back the past few years, we can see that the $6 billion free cash flow for the 2023 number seems reasonable, possibly even a bit on the conservative side if we think that the recent years are any sign of what's to come for Ford in the future. Okay, so overall, I'm happy with our estimates. And when we jump back to our calculation of fair value, well, we can see that this calculation gives us a fair value of about $24 per share. But this is a fair value of the entire company. We should really account for Ford's debt since they have a ton of it. So as of the end of the first quarter of 2020, Ford had almost $170 billion in debt, and they had about $46 billion in cash as well. So when we account for those two, well, this is what our new calculation looks like. And we can see that we end up with a fair value of Ford stock of about negative $8 per share. Now, since the stock cannot actually go negative, it would seem that because of all their debt, their stock could very well be overpriced right now at the current price of about $6 per share. Now, I'm not truly suggesting that this company isn't worth anything. Clearly, they have a brand, and that's going to be worth something. They also seem to have the backing of the US government, so that should help them. And maybe they end up cleaning up some of their debt and increasing their free cash flow at a faster rate than we've predicted here. So it may very well be worth more than this. But for me, since I do own one share, well, I'm probably going to sell that share at some point in the near future now that I've more thoroughly researched the company. And I'll see if I could find a company that I feel a bit more confident about over the long run. Now, since I'm not too keen on Ford stock at this point in time, if you're curious about a few companies that could be interesting for us to do a deeper dive on, I did a video just recently of the 3 best and the 3 worst performing stocks during the coronavirus stock market crash. There could be some gems hidden in there. If you're curious, there's a link right here, and there's a link in the description below. And thank you so much for sticking with me all the way into the video. I really appreciate it. Thanks, and I'll see you in the next video.